What does flexibility mean with regard to indexed universal life, IUL? And what does it mean to create grandfathered room? This is extremely insightful. Get ready. I think you're going to be blown away. So I'm Doug Andrew. I've been a financial strategist, retirement planning specialist now for 5 decades, helping thousands of people prepare for long-term goals such as retirement, to not outlive their money, to be immune from the negative impact of taxes, inflation, and market volatility, which are the 3 dangers that cause most retirees to outlive their money. So without question, if you've watched very many of my videos on my channel, my favorite vehicle is Max Funded Indexed Universal Life, or IUL, because it eliminates those 3 dangers. It's tax-free, so you don't have to worry about taxes going up. You link your returns to the things that inflate. I don't like inflation any more than anybody, but it doesn't hurt me. I'm able to outpace inflation by linking my returns to the things that inflate, okay? And then by using indexing, not index funds, indexing, I'm able to eliminate the danger of market volatility, because when the market goes down, I may not make anything, but I don't lose. And when the market goes up, I make money. And so it's my favorite vehicle. Now, in this episode, I'm going to talk about another reason why it's my favorite vehicle, and it's because of this word right here, flexibility. Now, I have a beatitude I've used for years: blessed are the flexible, for they shall not be bent out of shape. Yeah. You must remain flexible because life happens. You don't know when you're going to get disabled temporarily, permanently, get sick, get laid off, or a pandemic happens, or things out of our control, and all of a sudden the plan that we had to save money or to make this much profit in our business, we go through a recession or a setback or whatever. And a lot of people saw that during like the COVID-19 pandemic, okay? Now, when you set up an IUL, you're designing that indexed universal life insurance policy to accommodate the most money that you want to reposition, to optimize, to increase liquidity, safety, the rate of return, and the tax benefits. That's called the laser test. That's why we call a property structured IUL the laser fund, because you're wanting to optimize assets by increasing the liquidity, the ability to access your money, the safety, the rate of return, and turn it to be tax-free, not just tax-deferred. And so when people come and they go, okay, I want to utilize this, and let's say it's a 60-year-old and they want to reposition $500,000 into this. Well, they can't put it in all at once because of certain tax citations. The most they could probably put into it would be about 20% a year. So a 60-year-old male might be able to put in about $100,000 a year the first day of the first year, and the first day of the second year, another $100,000, and then the third year and the fourth year. So the 5th payment, if they wanted to really hurry and get it in there, would be actually in 4 years and 1 day. So we have many, many sophisticated clients that will maximum fund their IUL in 4 years and 1 day. But it's basically 5 deposits of $100,000, okay? I'm just keeping it simple. So you're maximum funding it. Well, so you design this thing to accommodate $100,000 a year. Now, what if something happens and you can't transfer the money in, or you need to put it off, or something didn't happen, or maybe some of the money was coming from the sale of a rental home and then you decided not to sell that rental home for another year because the real estate market plummeted, or maybe you're expecting a lump sum or a settlement from a car accident, or a lump sum or inheritance, and it went through probate and it got delayed, whatever, okay? So many times, if I have clients and their plan is designed to be maximum funded in 5 installments, the fastest they can do it, and they take the least amount of insurance, you design it to accommodate $500,000 or $100,000 a year under the TAMRA tax citation. Does that mean you're obligated to do that? No. I mean, the insurance company will probably send you out And notice, based upon, I intended to put in 100,000, that might be the planned premium. But you don't have to put in 100,000. In fact, an IUL policy is so flexible that if you put in 100,000 the first year, and then you didn't have 100,000 the second, third, and fourth year, you don't have to add anything. There's no cost that you have to cover, because the first 100,000 is probably 10 times more than what was needed in order to cover the actual costs of the life insurance. So the costs were only maybe, for the amount of death benefit required by the IRS, maybe only 10 grand. You put in 100 grand. I mean, you could coast for, 10 years in that example without adding a dime, okay? It's that flexible. Now, most people end up depositing the money on the schedule. But if you don't have it, you don't have to put it in there. Now, I do have many clients who realize that they don't want to chance it by putting it off. I don't want to wait until I have my 500,000 in hand, because I'm really sure I'm going to have that 500,000 within the next 5 years or so. And I go, well, now that we know you're healthy and you can qualify for one of these, it would probably behoove you to get grandfathered. So what does grandfathering mean? Okay. It means if they are likely to have that 500,000 in the next 5 years, but a big chunk of that's coming from an impending inheritance, or maybe a lump sum option at retirement. Instead of taking a pension, they're going to get a lump sum. Or maybe it's from an automobile accident, whatever. Maybe they're going to sell their business, whatever, okay? So if they're pretty doggone sure, we start grandfathering room, which means I'm going to make sure we have room for $500,000. And at age, let's say you're age 60, the minimum death benefit is only $1 million, okay? Now, again, you could buy way more insurance than that for $500,000. That's not the objective. You want the least amount of insurance. But see, you want to make sure the cost of that insurance, even though it's only $1 million and you put it in 500 grand, you want the cost to be as small as possible and to get cheaper as you get older. That is accomplished by maximum funding it as soon as you can. But if you're able to do it pretty much predictably within 5 years, it's not the end of the world if you don't get it done in 5 years. But if you get it done within 10 years, it's still going to zing, but it's going to grow faster the faster you get the money in. But you can only get the money in as fast as the IRS allows. And in this example, that's 20% a year. So you're allowed to put in, let's say, 100,000 a year for 4 years, and then one day into the 5th year. That's the fastest I can put it in there. But if I don't have the 100,000, if something happens, it's flexible. I could put in just 100,000. I could just put in 10,000. I could have put in 100. That's how flexible it is. And now it's good, it's open. But see, I'm grandfathering 90,000 of room. If I put in 10,000 and I could have put in 100, 90,000 is grandfathered room as compared to a qualified account like an IRA or 401k. If you don't use the little bit of room they give in a given tax year, that the percent of your income or the dollar amount that they'll let you put in, if you don't use the room in a given tax year, you lose it. If you don't use the room, you lose it. With IUL, if you don't use the room, you don't lose it. So let's go back to this example. If I could have put in 100,000 a year and I don't, I only put in 10,000, 10,000, 10,000. I put in 30 grand, but I could have put in 300,000 at that point. So there's 270,000 of room. I can make up that 270,000 anytime I want. You don't have to spread it out. I can put in 270,000, and if it's the beginning of the 4th year, I can put in another 100 on top of that. I can put in 370,000 in one fell swoop. And people say, well, don't you violate TAMRA? No, because TAMRA is a law. If you don't use the room, you don't lose it. And so the most I could put in was 100. I only put in 10, so I can make up the difference. That's the beauty of the flexibility of indexed universal life. So as you grandfather yourself, I've had many, many clients that then they get this windfall and they're able to throw in the huge lump sum and hit the ground running because they grandfathered the room and they didn't take the chance of waiting until they actually had the money in hand. And then the clock starts ticking from there for 5 years. You finally wait till you have 500,000 and you can only put in 100 grand a year. It's like, well, what do I do with the other 400,000 and then 300, then 200 as I peel off 100 grand a year? It may be better to nurse it along with 10 or 20 or 50,000, a lower amount. And then when you have the lump sum, then you can just go put it in all at once because you grandfathered room and you qualified years before. You don't have to worry about, I got to stay healthy and still be able to qualify. Otherwise, I got to use a surrogate, my spouse or my kids. So that's the beauty behind flexibility. You can put in this much, but you don't have to. You can put in this much. It would behoove you to put in this much, but you can make it up anytime down the road. And so that's why many of my clients will begin to grandfather themselves while they're healthy enough and while the tax laws are favoring them. Because if they change the tax laws, which I highly doubt they will, because of the insurance lobby is one of the strongest lobbies in this country. But if they change the tax laws, they've always said, because of the ex post facto provision in the Constitution, only new insurance policies taken out after the law change may have different limits. If you took one out based on previous tax law, you're fine, you're grandfathered. That's another reason why you may want to grandfather under known tax law today. And when you take it out, you operate under that tax law, not under new tax law they may pass down the road. Does that make sense? I can't guarantee that, but that's called grandfathering. So if this is resonating with you, learn more about this. Our 11th book has been flying off of our warehouse shelves. It's called The Laser Fund. A laser fund is a properly structured, max-funded indexed universal life. It stands for liquid assets safely earning returns. And this is 300 pages, and you have 200 pages of charts and graphs and explanations for the left brain learner. If you're a right brain learner, you flip it over and there's another 100 pages with 62 actual client stories. This retails on Amazon for $20. If you buy it on Amazon for $20, thank you, but I'll gift you a copy free. Here's how you can claim your free copy. I do require a little bit of skin in the game. If you go to laserfund.com or click on the link below, you contribute a nominal amount towards the shipping and handling. Okay, I cover the rest of that and I pay for the book. I will fire out a hard copy to you via priority mail. And while you're in there claiming your free hard copy, if you like to listen and learn or watch and learn, there's audio and video formats there. And there's even an opportunity where you can schedule an appointment to talk to an IUL certified professional. Why is that important? There's a lot of agents out there that have licenses and they sell IUL and they don't know how to create this kind of flexibility, okay? And what does it mean, basically? If they were to set it up like most agents do, who don't know what they don't know, you would be lucky to get a gross average rate of return of maybe 7, and you'd only net 2 or 3. That's pathetic. If you go to a certified IUL professional, then they'll rebalance and diversify, and you will self-insure. Your cash value will grow to equal and exceed the death benefit probably within the first 10 or 15 years. Now the insurance is getting cheaper as you get older. But if you were to use one that a IUL certified professional set up, then your rate of return would likely be 9, 10, 11. And if you earned 11, you'd net 10. Only 1% actually went towards the cost of the insurance because they set it up right, okay? It's huge down the road. And so you can set up an appointment, no cost or obligation with a certified IUL professional, ask them the questions, do a quick consultation, and they'll even create some illustrations for you based upon your particular set of circumstances so that if you're going to do it, you know how to do it correctly. And if you want to use them, that's fine. You don't have to. Is that fair? So take advantage of that. Click on the link below and schedule a time to talk to a certified IUL professional.